Thank you, everyone, for attending the CHEP seminar this week. We're very fortunate to have Prashant Bharadwaj here to give a talk. Prashant is an associate professor of economics at University of California, San Diego, next door. He's also the director of the PhD program there. Prashant has done a lot of work in labor economics and in health economics, development as well, including human capital acquisition among children. He's published in sort of the top journals in the field: the American Economic Review, the Journal of Labor Economics, Journal of Public Economics, Journal of Human Resources, Journal of Health Economics, making us incredibly envious. And today he's going to present some new work on digital loans. Thank you so much, Prashant, for doing this.
Great. Thank you so much for having me here. I live next door, so this has been the shortest commute to a seminar ever. Some of my neighbors are here because given my academic schedule, they don't believe that I do any real work. So I figured this would be a good opportunity for them to see what I actually do for a living. So this is joint work with a good friend of mine from grad school, M-Shwari, who's at MIT Sloan, and Billy Jack, who is at Georgetown. There's going to be digital loans, and we're going to provide some evidence from a great digital loan product called M-Shwari in Kenya. Clearly, Tavneet is the person with the most on-the-ground knowledge. So if you ask me questions about the context, I know quite a bit, but if you ask me too deep a question, I'm going to have to defer that for Tavneet. So the starting point for a project like this as a development economist is a fairly obvious start, which is the notion that credit is essential in the developing world. There's tons of work written on this. The theoretical reasons for this is obviously one that stems from thinking about consumption smoothing and how important that is, especially when incomes are at risk, when income sources are fluctuating, and so on. And so we think that credit can play a really important role in helping households smooth consumption in these high-risk areas. Not only for smoothing consumption, but also for in terms of making investment decisions that are then yielding high returns. The promise of microfinance from that perspective has been put forth, but really the evidence on this, as I'll show you in a couple of slides, does seem fairly mixed. So it's not obvious that microfinance is being able to, is sort of delivering on this need for credit that arises in these contexts, both from a consumption smoothing perspective as well as from a business investment standpoint. So where this paper comes in is sort of really taking this old notion of looking at the importance of finance in the developing world, but utilizing some of the newest, latest technologies that have come on board that are really changing the landscape of finance in the developing world. And the platform that we're going to talk a lot about, the platform upon which the product that we're talking about is built, is the mobile money platform. Okay? So mobile money is now present in 93 countries. There's 411 million or so accounts. There's 32 million transactions a day that is done on mobile money. And nowhere in the developing world is this more popular than in the context of Africa, and in particular in the Kenyan context, where really sort of the M-PESA program has been shown to transform lives, transform risk-sharing networks, and so on. So really, the project we're talking about today comes at the intersection of mobile money technology and this traditional space for credit and microfinance. And the question we're asking is, can fintech sort of change the traditional financial services and deliver on this promise of finance being an essential tool for households to cope with shocks, for households to be able to smooth consumption in the developing world? So not everybody here is perhaps as familiar with why microfinance didn't work, so I'm going to give you a little bit of background on sort of traditional microfinance and how the product we study is going to be quite dramatically different. So traditional microfinance is, this is the Grameen Bank style model, is built on, the traditional models are built on notions of group liability, where many people undertake the risk. Some of the programs tested women-only programs, and so on. Perhaps one of the defining features of the microfinance product is typically high interest rates. The product we study will also have pretty high interest rates. But the idea was that these interest rates were high, but still lower than the traditional option, the outside option, which is typically a money lender or borrowing from family. The thing that made microfinance sort of very attractive for people to talk about and for it to spread all over the world was this notion that there were very low default rates. And part of that was attributed to the fact that the early versions of this gave loans to women or gave loans as part of a group, which helped lower these default rates. Yet, despite the sort of proposed promise, when we actually look at some of the data, take-up of microfinance seems to be fairly low as well. So it's not the case that if you offer people microfinance products, that the take-up was substantially high. Okay? And so if we look at some of the old traditional take-up rates from this review article by Carlin, Murdoch, and Mullainathan, you basically see across a whole bunch of countries and contexts, the take-up rates, conditional on being offered, seems fairly low. So this was a puzzle that people had been thinking about for a while, just on the take-up margin. And more recent evidence on traditional microfinance models not only shows that take-up is low, but even conditional on you taking up a loan, the effects of this don't seem particularly promising. Okay? So this is the articles that came out in January 2015 issue, I believe, of the American Economic Journal. This was a special issue on microfinance, where they basically analyzed 6 randomized controlled trials across Bosnia, Ethiopia, India, Mexico, Mongolia, and Morocco. Of course, as you can tell, the types of programs varied, and again, you again sort of see the high sort of interest rates pop up here. And these vary in terms of how the structure, in terms of how they were structured, so you can't do a true sort of cross-country comparison. But I think what you basically see is, while they all these programs led to an increase in credit access and increase in business activity, which is what these products were sort of traditionally designed to deliver, you don't see much on income, you don't see much on consumption, and you don't see much on these social effects. Okay, so social effects, I mean investments in education, investments in health, so on and so forth. So really this is where sort of the question of, is microfinance truly delivering on its promise, is being started, people have started to sort of question that in academia.
So are these treatment on the treated sort of effects, or intent to treat?
These are intent to treat effects. Yeah.
Now, how would it possibly have a negative effect on consumption?
People are in debt. So in 6 months after you borrow, you actually lower consumption in order to pay back those loans. And actually that's another concern with the traditional microfinance model, is that and there are some papers not in this set, but in a different group of papers, people have measured mental health outcomes and they find decreased mental health outcomes for people who have taken these microfinance loans. Yeah. Okay. But anyway, this is not my paper. This is just trying to set up the scope for what traditional microfinance looks like. And this is where we come in terms of thinking about mobile phones. And the product that we're going to study today is a fully digital banking product. Okay? It's called M-Shwari, and you can essentially have credit and savings over mobile phones. You open the account using a mobile phone. There's no face-to-face interaction. There's no brick-and-mortar interaction involved. You can have, it's not even on a smartphone, it's on a dumb phone. I'll show you some photos. You can open up an account, you can start borrowing, you can start saving on that account. And the rails upon which this is built is again the M-PESA network, which is the mobile money platform. Okay, so there's the mobile money platform, which is called M-PESA, and then there's the credit and banking platform, which is called M-Shwari. Okay, so just to keep those terms. So of course, I'm not going to write down a model for why we think a digital platform might have impacts, but you can look at Dan Bjorkhagen, I can't pronounce his last name, but he's an assistant prof at Brown. He has written some really nice theory papers on why we might expect the digital product to expand credit and for that to be profitable for both, for that to be profitable for lenders. One of the primary channels through which we think this is made popular is that it lowers costs on both sides. Okay, so lenders, once you figure out how to rate credit, which I'll get to, which is going to be the key aspect of how this product actually works, once you figure out how to figure out someone's credit score, it's going to potentially lower the cost for lenders because you have access to a whole lot of people, and you can give very small amounts, okay, which traditionally was not possible because there were fixed costs of loan delivery that banks have to incur. Now those fixed costs are essentially minimized. And so for customers, that's really nice as well, because you no longer have to enter group loan, sort of lending contracts. You don't have to enter into any of these things. You can take out really small micro amounts. Okay, so while I try to contrast this with, or sort of compare this to the microfinance thing, the key way in which this is also different is that the amounts that we are observing people take out is also much lower. And the ceilings on these loans are much, much lower than sort of the traditional microfinance loans that you see in this space. Okay, so there's going to be quite a few pictures, but this is what M-PESA looks like. So I'm going to talk a little bit about M-PESA to give you a sense of what the mobile money platform is like, and then get to the digital banking side of things. So these are sort of typical phones that you can use, that people use. This is the dumb phone version, that's the smartphone version. And what you can do over here is, M-PESA is operated through the telecom, okay, through Safaricom, which is the largest telco provider in Kenya. You can pay your bill, you can buy airtime, you can withdraw cash, you can buy goods, all through this mobile money network. Okay? And the way this works is you basically have these little shops all over the place. If you've been to any developing country, you'll see these kinds of shops, right? And you can see the sign for M-PESA is up here, all over the place. So what these stores are doing is that these stores essentially act as agents for e-float. And the way to think about M-PESA is essentially like cash, but on a digital platform. People would go to these stores, they give 100 Kenyan shillings, and to the agent accepts 100 Kenyan shillings in cash, and provides on the cell phone 100 shillings or some fraction thereof after transaction fees of e-float, of just equivalent e-float. Okay? Now with that, you can go to any store and you can transact over this network. If you want to withdraw money, you see the withdraw cash option. They'll go to this same store. You can withdraw cash. You can say, hey, somebody paid me 20 shillings. I want to withdraw that. And you can just go to it. Imagine Venmo, but with agents instead of having to go to your physical bank, right? So when I transact with my neighbor Tony on Venmo, we can't go to an agent. If we truly need to withdraw the cash equivalent, I need to go to a bank and do it. But now you can do this with agents. That's sort of the idea here. And the business model for M-PESA is to get these agents to go everywhere and bypass brick and mortar stores. I mean, sort of brick and mortar banks. Okay? These stores have always existed. The key is to convert them into becoming M-PESA agents. And of course, the secret to their business model is figuring out how to compensate these agents, and that's the spread of M-PESA, because they are competing mobile money platforms. So the spread of M-PESA, the determinant of that is how they compensate these agents, okay? Or what sort of contractual deals that they give them. And that, of course, we don't have access to. Okay? But you can tell that the growth in terms of M-PESA adoption is absolutely tremendous. Okay? And this is the notion that, these are not spaces that had traditional modes of payment like credit cards and things. They had cash and nothing else. And all of a sudden you had this mobile technology enter, so they leapfrogged all these in-between options and they just went straight to mobile money. In some ways, this is what the Indian government tried to do, or at least what they say they tried to do with the demonetization experiment from 2016, where they pulled out a whole bunch of cash from the economy and tried to get people to go digital. The argument at the time was, why do they have to do that when people naturally gravitated towards that in other contexts? Okay? So what you can see here is across different portions of the income distribution, you have just absolutely high rates of M-PESA adoption. So nearly 100% of households, and nearly everyone here has a cell phone. So nearly everyone in this context is transacting on this mobile money platform. Okay. So my colleague, my friend Tavneet has done a lot of work on the impacts of M-PESA. As you can imagine, in the short run, M-PESA itself improves resilience. And improves resilience, as she shows in her work, by making risk-sharing networks more efficient. So if I fall sick, I can now, instead of relying on some person on getting on some bus and bringing me cash, I now can get cash delivered on my phone from my relative who lives, 200 kilometers away. In the long run, this has been shown to reduce poverty and particularly have effects on women. Okay, so women have more agency through this platform. Okay. All right, so let's get to the product that I study here, which is fully digital banking. So now that you understand how M-PESA works, it's the exact same thing, but now you can open up an account, a bank account on a phone. Okay, and it operates on the same rails as that of M-PESA. There's lots of different players in the scene. The product that we study has the largest market share. But these are all bank-led. This is with the Commercial Bank of Africa. That's who M-Shwari has teamed up with. But we have KCB M-PESA, Equity Easy, lots of different institutions that provide this. By and large, the interest rates are pretty high. The monthly interest rate is between 6 to 12%. So the analogous version you may want to think about is something like a payday loan. Because the amounts are small, interest rates are high. So payday loan is perhaps a good analogy to this context that we're studying. Yeah.
So having a little sense of kind of where you're going with this paper, what can you tell us kind of the relative market share of M-Shwari versus kind of the next biggest one?
Could not have teed up that question better. It's by far and above the largest market share. Yeah. Yeah. And it's actually increasing even more. So there's been sort of gains to having traction. And so I forget when these numbers are from, but to me tells me that more recently M-Shwari is really winning the race on this against even KCB and MICROFINANCE. Okay. So a lot of people are using these kinds of products, and M-Shwari has the largest sort of market share. Okay. So there's 15 million accounts, 75% of adults have at least opened an account on M-Shwari. So 1 in 5 Kenyan adults have an active loan on M-Shwari. So it's really the largest banking product, digital banking product in Kenya. These are the details. It's a 30-day loan, okay, and a facilitation fee, as they call it, of 7.5% per month. And there's a reason it's called a facilitation fee and not an interest rate. And this allowed them to move around some legalities when the Kenyan government imposed interest rate ceilings. I'm going to come to that towards the end of my talk. There's a whole separate project that we are thinking about doing with that on interest rate caps, which I think is really fascinating. But it's a fee of 7.5% per month, and the first loan can be as low as $1, as high as $100. Okay, and the mean loan in our sample is about 500 shillings, which is about $5. So again, these are, I started off by comparing it to microfinance because that's what most people have in mind when they think of credit in the developing world. But at least in terms of loan amounts, microfinance, as you saw in the other table, mean loan size was around $400, so this is much
To
smaller.
get a sense of what that means in Kenya, what is the average income per month?
Okay, so for the population that we study, it's about $2 a day.
2,000
$2 a day.
a day?
Yeah, that's
Okay.
for the population that we study. So again, we are going to focus on a particularly poor portion of the population because these are people with low-ish credit scores. So this is not going to be the richest portion of the income distribution. Yeah. Okay. Account over, you open it over the mobile phone, you deposit, withdraw using M-PESA, loan requested over the phone. Okay, so I can take a loan from the bank, go to the agent and withdraw cash if I need to. I can take a loan from the bank digitally and also just use that to pay people digitally. Of course, now the key is, how does the bank determine creditworthiness? Okay, this is the key that allows these kinds of technologies to exist is being able to rate people. Okay, because that's the thing that has been lacking in the developing world. The reason microfinance interest rates are high, the reason people are unable to take loans is lenders are unable to figure out risk, right? But now you can. Now you can, because people have been using cell phones for a while. People have been using M-PESA for a while, so you now know transactions a little bit. Okay, so you can use the cell phone data, which is commonly done everywhere, even in this country. And so what you can do is you can essentially create a credit score as some function of airtime expenses, airtime loans, airtime transfers. Of course, we don't know the exact formula, but we know that they use some of these ingredients to create this credit score. There's a dynamic aspect to this, as is in most cases, which is that credit scoring gives a loan limit which is going to increase if it's repaid on time and with savings. So remember, you can also save on this platform. So the more you save, the more they're going to increase your credit rating on this.
Is there anything we should know about, that would be helpful to know about the regulatory environment in Kenya involving sort of traditional loans versus sort of this new market entrant? Or?
Yeah, so what's interesting about this, the regulatory space here, is they in 2016, they introduced interest rate caps in the run-up to the election. So that was done for all banks that charged an interest rate. This is why these guys were exempt from it, because in their legal filings they call it a facilitation fee, not an interest rate. And so they were able to escape that, and then they also regulated a floor on the savings rate. Okay, so you couldn't have a savings rate below a certain amount that, an interest rate on savings. You had to provide a floor, right? And so they imposed that floor, they raised that minimum. But other than that, I mean, I think these guys, there's, in terms of, if you're thinking of sort of the traditional banking insurance, there is banking insurance in this context, but the way it's done is it's not done per individual. All of the credit, all of your, so let's say you're saving or you're borrowing from me, all of that goes to a central depository and it's not in your name. So that. Okay. You get reported to the credit bureau after 120 days of non-payment, and the savings are used to automatically clear the balance. They can't access airtime or your general M-PESA account to clear your balance. Okay, so that's important. So what are we going to do? We're going to, of course, use the credit score cutoff for eligibility in a regression discontinuity framework, and we're only going to use the initial credit score to determine eligibility. Okay. Again, we're going to only use the initial as sort of an intent to treat sort of parameter, because once you get access, then subsequent moves are sort of endogenous. Or even if you're slightly below the cutoff, over time we can see that you are accessing loans, but that's because you've done things to sort of improve your credit score. So the initial credit score when you start an account is what we're going to do to figure out eligibility. Yeah.
So is there any, to your knowledge, spatial heterogeneity in how the cutoff is determined? So for example, like in different climate regions of Kenya, for example, that might be exposed to weather shocks or something like that.
So,
or is it sort of a uniform algorithm that's applied to anyone, anywhere?
So one of the most frustrating things about working on this project is we know nothing about the geography of our sample. We just know their numbers. And because of privacy concerns, we were not allowed to access anything about the cell towers from which they regularly make calls or where these guys are located. Because you can imagine that one could do a lot more in terms of thinking about the effects that we observe. There's any spatial heterogeneity in the effects. To answer your question more precisely though, there is no evidence that that M-Shwari uses different cutoffs in different geographies. So they seem to be using a uniform cutoff. Because otherwise we would not find, we would find a more fuzzy
right. Well, that's kind of the
right?
question, yeah.
So we don't, so empirically we can validate that that's not the case. And also speaking to sort of the CBA, they didn't tell us that they use different cutoffs in different spots. But in general, there's nothing on geography that I can show you, no heterogeneity by geography, which is something that I really wanted to do at the outset here. Yeah.
So just to clarify, the discontinuity that you're getting is this credit score, and that it's not about qualifying for a better rate. It's do you have access? Can you borrow? Yes or no?
Correct.
And
Can you borrow? Yes or no?
Okay.
Yes. Yep. Okay. Before I get into data and everything, I have a little video I can show you on M-Shwari, and Let me just go ahead and show you that. Just so you know, it sets. Development economists are notorious for having pictures and videos in their talks. So.
M-Shwari is a new banking platform, a partnership between the Commercial Bank of Africa and Kenya's biggest mobile network, Safaricom. It expands Kenya's pioneering M-PESA payment system to a simple bank account where customers can earn interest on savings and access small amounts of credit instantly on the mobile phone.
You can literally apply for it and get a reply within seconds over your mobile phone, and that's an incredible development in the Kenyan market.
People are very aware, already very conversant with transacting mobile, whether it's doing banking or paying for water. M-PESA really has to be credited a lot for that. The fact that we are riding on a very familiar and trusted brand in Kenya helps a great deal.
I had 1 shilling in my M-PESA, then I activated it with 1 bob, 1 shillings, because they had said you can start selling by 1 shilling.
Evelyn Mumo supports 3 kids by buying second-hand wools that she sews into wigs. Evelyn began using M-Shwari to save, and now she also uses small loans to buy stock for her business.
My customers there, and a lot of them, but my money was little. That is the day I realized that even if you don't have money in the M-Shwari, you can also borrow.
Evelyn started with a 100 shilling loan, and she's been steadily building her credit limit by paying back carefully within a few days. Her savings will help her achieve larger loans. Loans have to be repaid within a month with a 7.5% fee.
Enter amount the loan, the amount of money that you want, let's say it's 5,000.
Lucas's limit has just gone down since he was a few days late repaying his last 1,000 shilling loan.
Then you enter the pin. Your loan request was declined because the amount was higher than your maximum limitation. You are currently not qualified for. You are currently qualified for 800 shillings. Make sure it doesn't pass 30 days. If you pass the limitation of the time, they tell you that they will report you to Kenya Credit Society so that they block you from taking any loan again.
M-Shwari is signing up 12,000 new customers every day.
We achieved 1 million customers in 41 days. If you compare that with something like Facebook, Facebook took 10 months to hit 1 million customers.
Okay, that just gave you a flavor of a couple of people, how they access these loans, what difference it seems to make. Of course, this video was likely produced by M-Shwari, so let's take what they find with a pinch of salt. But what we'll show you is not as much on the enterprise side at all, but on the resilience to shock side, we will have some results. Yeah.
So with there being that month limit for when you have to repay, is there also evidence of more predatory lending on the ground for people to kind of like fill the gap for repaying their digital loans?
That's a great question. So one of the things we were looking into when we started this project also was to what extent does M-Shwari substitute for other forms of loans, or does it lead to sort of informal loans now coming into the market or decreasing from the market? I'm going to show you that it doesn't seem to change any of the other access to credit points. So this seems to be, the way we interpret the results is that it's a net increase in credit access as a result, because nothing else on the formal or the informal loan structure do we see sort of any impacts. Yeah. Okay. Okay, so the results are going to be interpreted as the effects of longer access to M-Shwari loans in an intent to treat framework. We're going to follow standard RD procedures. I'm not going to show you estimating equations and stuff, but you can imagine it's all going to be done in pictures. My general rule of thumb is if an RD doesn't show up in a picture, I don't really care if the stars are around the coefficients. So I'm just going to show you the fairly raw, untainted plots, and we can all discuss whether those are effects or not. Okay? And you can put in flexible controls and things. I mean, I've presented RD papers before, and they are incredibly boring to present, because once you see the main picture, then the presenter spends 30 minutes showing you, oh, it's robust with this bandwidth, that bandwidth. I'm going to try and not do that, but we're just going to get to the results, and we can have a more fun discussion of the bigger picture. And you can look at the paper to see if things are robust or not. Okay, where did we get data from? We got admin data from the bank with credit scores. And then what we did was, because we knew of this cutoff and we knew the cutoff point, we could then do a more focused household survey. And we did the household survey over the phone. because obviously we have their phone numbers from the bank, right? It's a digital loan product, so obviously we have their phone numbers. So we could just call them up and conduct a household survey. So we picked a random sample of about 6,000 clients who opened their M-Shwari account between January and March 2015. So this is the key. They did not have an M-Shwari account before. This is the first credit score that they are assigned in the system. That's the idea. And that's why this is a fairly decent intent to treat variable, right? And so because we knew the cutoff, we could also do this around the bandwidth that we think is reasonable. So this really helped us reduce our survey costs. Okay, we didn't have to capture the entire distribution of credit scores. We could focus it on the -10 to +10 around the credit score. The bank wouldn't tell us the numerical version of the credit score because we have all of the ingredients from which we can construct this credit score. But they told us what the 0 was, and so they essentially gave us an admin data set that had -10 to +10 in bins of 1, and the 0 was where the cutoff was. Yeah.
So these are all going to be kind of local average treatment effects then around kind of this population that has the credit score right?
Absolutely.
Which is think about that relative to either maybe the general population of Kenya as a whole, or populations that have been targeted by these microcredit programs as well?
Yeah, so absolutely awesome questions. This is about 15% of the overall credit distribution lies within this sample here. In terms of thinking about, and these are definitely the poorer half of the, not the half, but less than half. They're definitely on the poorer side of the overall population, which is typically, the population where we think we might find effects for these kinds of microfinance interventions. But in terms of what this means for these kinds of products to generate income through enterprise, this is perhaps not the right sample, right? So the fact that we don't find effects on a whole range of labor market outcomes, finance and stuff like that, ultimately shouldn't be as surprising because these are fairly poor households taking out small amounts, typically during emergencies. So maybe for richer households that have other sources of income for dealing with emergencies or don't face as much risk, maybe these digital loans do have impacts on enterprise-related outcomes, but that's just not something we pick up here. So that's sort of how I view the trade-off. But in terms of thinking about consumption smoothing and response to shocks, this is perhaps an appropriate sample, but not in terms of thinking about enterprise.
And so sorry, I'm not
No,
anywhere near
fine.
familiar with the
Please.
other literature on
Yeah.
microfinance. So how have they been sort of identifying effects? Is it roll out to these programs to the average person? I mean, kind of back to sort of Ryan's question about who the marginal person who's sort of taking up the loans in the other sort of previous studies. So that we know they're larger loans, and who are the marginal people taking it up, and how are they identifying sort of take up in general?
Yeah, so most of this literature does intend to treat take-ups, right? Because they offer loan products, and that's why take-up is important, and take-up has been shown to be low in along these contexts. Most of these, so the 6 studies at least that I showed you, those were randomized controlled trials where the offer is there. Then you also had sort of the...
And who are the participants in the trials?
Yeah, so those are typically at the village level. So you can have access, you go around, you give access to, for a random subset across villages. That's typically how the studies are clustered. One of the more famous papers that was not part of the 6 is called the Miracle of Microfinance paper. That was around poor urban areas in southern India. So across urban areas, they went and set up MFIs, and they talked about what is the impact of setting up an MFI in these areas. But yeah, they tend to be targeted towards the poor. There's no question. Yeah, because again, remember that if you are well off in these samples, you actually, at least compared to microfinance, you have much cheaper loans that you can access through traditional banking networks. You don't have to go through microfinance. Yeah. The traditional banks give much better loan terms. Okay. The phone survey. The surveys were done about a year. So January through March 2015 is when they opened the accounts. So about a couple of years after they opened the accounts, we did the phone survey. Okay, that's where we get the outcomes from. We get about a 70% response rate to our phone survey, which is really high if you think about phone surveys. We don't pick up any of our robocalls anymore, right? So imagine some poor researcher like me is trying to contact you and try to figure this out, and we're all turning down these phones. But there's a 70% response rate. It was actually, I was talking to Tavneet about this high response rate. Apparently that's just how it is right now. It's not yet reached a point of saturation in the developing world, at least in the Kenyan context, where people are just sick and tired of being on the phone and refuse to take phone calls. So phone success rates, phone survey success rates are actually pretty high. And key for our study is that this is not differential across the credit score. Okay. Just a few things to note on our sample. The average age of our customer is about 30 years. Fairly even distribution across men and women, 48% male. These are all different characteristics of the sort of M-PESA. So think of these as the ingredients that go into the credit score. Okay, so this is what is showing you. What this is showing you is cell phone data on these guys in the previous 6 months. So number of low days is if your amount of airtime goes below a certain limit. Remember, this is all a prepaid context for cell phone usage. This is not a context where we have AT&T or Sprint style contracts. Everything is sort of prepaid here.
And
right?
these are Kenyan shillings?
Yes, absolutely. Yeah. These are not US dollars. Not 100%. Yeah. So divide by 100, essentially. So divide by 100 to get US dollars equivalent. Okay. Okay. So for example, send clients. Basically, that means how many people did you send money to? Okay. So about 3.5 people.
So within those 2 years?
No. This is in the last. So depending on the question, I wish it's in the paper. I believe this is in the last 6 months or in the last month, something like that. Yeah. Okay, this is from the admin data. So I'm going to be switching a little bit between admin and survey, right? Because that's the nature of the beast here. The average household size is about 4.5-ish people. Number of girls, but sort of equal. This is not a context where we see crazy differences in terms of son preference. Pretty decent number of years of education. This is not what I was expecting at least. Despite these households being somewhat poor. About 10 years of education. This is not something you'd see if we were to do this in, say, India. I don't think we'd find it, but 10 years of education. That's fairly equal across household head and household spouse, although that's about almost a year apart, so maybe that's pretty significant. Okay. About 50% of our sample has taken a loan, and most households have at least about one outstanding loan at the time of the survey.
Did 13% of them move in the last 6 months?
Correct.
Wow.
Yeah.
That's a lot.
I don't have a good understanding of the denominator. I mean, of what the natural rate of moving here is. This is also a time, from the rural areas of Kenya. Maybe there's a lot of movement to urban areas. So you might expect to see some of these movements. I honestly don't know if that's low or high. I don't have a good sense of natural internal migration rates. Okay. Let me come back to these when I show you some results. So the first thing I'm going to show you is balance in the administrative data. So the key here is we need to make sure that this credit score does not somehow predict at the threshold the very ingredients that went into it. Okay, so we want to make sure that people are fairly similar on either side of the cutoff. Again, it's sort of a standard RD smoothness of covariate check. What you see is basically these guys are no different along age, gender, top-up amounts, number of loans, the low days, they're all fairly similar. At some level, these are the ingredients that go into the credit score, so you would expect them to be smooth here. Okay. You can also look at M-PESA transactions, and basically what you get is just a big fat zero and really small in terms of their mean values. So it's really not much happening at the cutoff. Okay, so there's tons of smoothness of covariates here, at least in the admin data. You also see the same when I skip to the survey data. So looking at households below the cutoff and just above the cutoff within that bandwidth, we don't see sort of stark differences there. Okay.
Sorry, Prashant, are these just testing like group means, or this is the actual RD?
Oh yeah, maybe I should have put up econometric specifications. So yeah, so what does this have? This has the linear splines on each side, and that's about it.
Oh.
Yeah, so it's the most basic version of it, but we definitely have the linear splines on each side. Okay, I told you parts of this paper will be boring to show. Okay, so the other thing about the RD is you need to make sure that people are not able to manipulate the running variable. So of course this is given to them by M-Shwari. It's really unlikely that M-Shwari is sitting around figuring out should I move one person just on the left to the right or vice versa. So of course at the cutoff we don't find anything. There does seem to be some bunching at one of the higher credit score points, and so it's possible that in the entire distribution there are these mass points. And so this goes back to sort of the question that Ryan had earlier, which is where are these people coming from? What portion of the distribution of the credit score do we pick up these guys? And so this is the 15% in this entire window. That's the RD window, the red lines that you can barely see on this graph. Okay? But you can tell that there are plenty of people far away from the cutoff. And remember, the only reason we have this is these guys open their accounts. So these fairly poor people are still opening up M-Shwari accounts. They're just not going to get a loan. As you saw in that video, the guy said, oh, I applied for a 5,000 shilling loan, but he's eligible only for 800. So there's lots of people who open up accounts potentially trying to get these loans, but just will not get access to them. Okay? At the same time, there are lots of people who are fairly well off also opening up these loans. Okay. So this is going to be the first stage. Whether the household received a loan and the number of loans that they received. And we can also recreate this using admin data. This is done using all the survey data that we have. So we asked households, did you receive a loan? Have you ever received a loan? How many loans have you received in the last 6 months? And so we can sort of plot these graphs based on that. What you can tell here is that the left-hand side is not zero. Like the mean here is high, which means because they were close to the threshold 2 years before we did the survey, by the time we did the survey, a lot of them had access to this product. That's why this intent to treat framework is very important to sort of keep in mind, right? It's not that I'm comparing someone who has access to zero access, it's just how long have they had access to the loan is more the right way to think about what the treatment here is. Okay. And of course, if that's the interpretation, then it's no surprise the number of loans people receive is also higher because they have had access for longer. And we can also tell that loan amounts and total debt that they have experienced is also much higher. Okay. This is the same thing in numbers and with different cutoff values. We did some multiple hypothesis testing because referees won't let us get away without doing that these days. Okay, and you basically see the same result. So what is, how do we interpret this? There's a 10% increase in the probability that anyone had a loan, if you're to the right of the cutoff, from a base of about 45%. That's a pretty large increase in sort of take-up, essentially. Okay. The number of loans you had was about 0.3 from a control mean of 0.7. So again, a pretty substantial increase in access. Total debt amounts also go up. There doesn't seem to be an increase from a formal debt source, so it's not the case that you take a loan here and then that somehow gives you access to better loans from the formal markets. We also do a subsample analysis on the interest paid, just as a way to try and think about indebtedness. We haven't really come up with a good way to talk about whether this program puts people in too much debt. We haven't fully figured out what that notion of too much debt here is in this context, but it's something that we're currently working on. Okay, so you can see that these are robust to different sort of bandwidths, number of loans. So the first stage is really strong and kind of robust. This is the question that was being asked about substitution from other loan types. And so when we see around the cutoff, what we see is that the M-Shwari loan is where we see all the action in terms of the increase in loans. We don't see any action in terms of substitution away from or into other loan products. So in particular, an MFI loan, which is a traditional microfinance loan, a SACCO loan is a savings and credit association loan. I don't know how many of you are familiar with ROSCAs. ROSCAs are rotating savings and credit associations, which is a really cool system where we used to call this a different thing when I was growing up. It used to be called a chit fund in India. It's basically people gather around and they put in, everybody puts in $5 every month and one person gets all of that pot in a given month. Then the next month somebody else gets that entire pot. So the idea is to give lump sum payments to people. So anyway, so we find nothing on sort of ROSCAs. We find nothing on the informal loans as well. Okay. So now let's look at outcomes. It's going to be effects on so what we think of as household resilience, but really not much on other productive investments and things like that. Okay. So in the first column, what you see is expenses foregone. So we asked them, in response to a shock, did you not spend money on something? Did you not eat a meal, or were you unable to pay for medical expenses? Did you have to take your child out of school? Did you have to leave a job? Did you have to sell assets in response to the shock? So the idea here is people who now have access to the credit should be less susceptible to the negative effects of these income shocks. Okay. So what you find is that, first of all, for expenses foregone for any shock, there is a pretty sharp reduction. So it goes down to about minus 0.06 off a base of 0.67. So really that means a large fraction of these people in this credit score threshold, A, are experiencing shocks, and B, are foregoing expenses in response to these shocks. Okay? And when they have access to credit, the degree to which they forego these expenses seems to decrease. Yeah, Ryan, you had a question?
Yeah, so when you ask them about these expenses foregone, how far back are you asking them? Is it the past month, past year? Or?
I believe in the past 6 months.
Past 6 months?
Yeah. It's in the paper, but I'm pretty sure it's past 6 months. Maybe we also ask about the past month, and we haven't used that yet. I have to get back to you on that. But it's I think for the most part here is the last 6 months. Okay, so you are less likely to forego expenses on medical. That seems to be a space where some of these results are coming from. You are no more likely to pull your child out of school, or leave a job, or sell other forms of assets if you're the right of cutoff. Okay, in graphs, this is what these look like. They're noisy. And again, remember, at some point we have literally 10 dots on either side. That's what we have to deal with in terms of the bandwidth. I don't have finer measures of this credit score, so these are all clustered at the credit score level. But this is why I said RDs, in my opinion, live and die by graphs, and so we can debate whether you find this convincing or not. But to us, at least, forego meal, forego medical, there's definitely something happening right at the cutoff that is, I think, interesting. And then when we combine these into any measure, it looks like it's a fairly robust result on any expenses foregone. Yeah.
So part of my previous question, now this is kind of thinking about this. Given that even the people that weren't eligible at baseline, right, kind of did things to improve their credit score, and that even those who were ineligible were still, I think it was like 40% of those people had taken out a loan. Do we think that this gap that we're finding here is due to the people who, is this driven by the people who just couldn't get their credit scores up to have access to a loan? Or is there something about having access to these loans and the system over a long period of time, you learn how to use them to smooth consumption throughout these negative
Yeah,
shocks.
that's a great point. I mean, if we knew, for example, how large an income shock they faced, maybe by looking at the loan limits that these guys were assigned to would be a good way to do it, because the longer you've been in the system, the longer you've had access to a loan, and if you've made the repayments, hopefully you have a larger credit limit, which might allow you to smooth these shocks more, which is why we find some of these effects, right? But to your question though, I mean, that's sort of the endogenous part that we don't want to touch, and that's why we're leaving these all as the intent to treat estimates, because exactly, the people to the left also have now have access. And so by sort of, it'll be hard for us to look at a sample of people who have access and then do the credit score, because these are no longer comparable people.
Yeah, you can't just do the scale it up by
I can't.
You can't do the treatment on the treated by scaling it up.
I
mean,
cannot.
If you did, I'm sure these magnitudes would be
Enormous.
huge.
Absolutely, but I cannot do that.
But if there's any anecdotal evidence of people kind of, I don't know, like if there's something about just having had it or practicing, or they know that, oh, there's a shock, I'm going to turn to this loan. Or,
Yeah, so the ideal thing for that would have been to get admin data at a high frequency level from these guys on loan repayment structures and stuff. I don't think we got access to that kind of data. But some sort of, I completely agree with you that maybe even a different paper to write about this would be on how people learn about managing loans. And one could potentially do that by sort of saying, now this sample suddenly gets access, right? And over time, how do we see these people build credit, and is there some learning behavior about it? You know, once you start having access to credit. That would be a fascinating paper to write. I don't think the data we have allows us to do that. Yeah, Prashant.
What's the explanation of why in both cases it goes down right after you get, you know, eligible for the loan, and then if it's $5 more, it goes up and then it goes down, and why is, and then you have the same thing in foregone medical.
Yeah. Well, foregone medical, yeah, I mean, I wanted to gently avoid focusing too much on any individual given dot. Foregone medical, there's 2 dots on that side that, you know, kind of make that hump shape on the right-hand side line. But in general, I agree with you. I don't think we have a very good explanation for what is happening for points away from these credit thresholds. They should all be at a lower level, which is what ideally we would think these effects should look like, right? I mean, these everyone has access. So what's happening to these guys in terms of responding to these shocks? And why is this an effect that we're finding at a threshold and not at other points of this distribution? It's a fair question.
Is there any more, I assume not, or you would have used it, sort of more detail on what type of medical care was foregone, in some sense of what the average cost for the medical services, just to get a sense of whether the magnitudes are sort of plausible given the size of the loans, taking into account that we are talking about sort of a long run, you know, potentially kind of a long run effect of access. I'm just trying to get a sense of how.
Yeah, we
that
did
big
not
a jump
ask
is
them
plausible.
we just asked if they suffered a shock and if they had to forego any of these expenses. We did not ask them how much they had to forego. So yeah, I'm unable to sort of answer that. Yeah. Okay. Robust to a bunch of different things. Okay, now I'm going to show you a bunch of zeros. We can look at total expenditures, okay? And what we see here is pretty much nothing. So, because of course the loan amounts are small, we don't expect these to move total expenditures in any meaningful way for us to pick things up. In terms of total expenditures, food expenditures, basics, across education, health, clothing, we literally are not picking up anything meaningful in this space. Okay. The one space in which we are finding some effects is a question of, did you spend on education? Okay. People to the right of the cutoff seem to be spending a lot more likely to spend on education. This is a dummy for positive expenditure on education. And remember, like, household structure and everything is pretty smooth around this cutoff. Okay, so we definitely are finding, but again, this is one outcome out of a whole range of consumption outcomes, so if we did the multiple hypothesis testing on this, it will not be significant. I picked one out of a range of 10 outcomes here, so. But just to show you a flavor for what the kinds of results and the kind of noise that you see in the data, that's what this is. Okay. Okay. In terms of investments, the number of savings instruments does go up. Okay. So this also makes sense if you think about how the credit program worked. If you saved, it allowed you more. So once you started getting access to credit, maybe that incentivized you to save in order for you to increase your credit limit and so on. Okay. Remember that everyone could save once you open the product. You can always save because that's not costly for the bank. But if you are to the right of the cutoff, you seem to be saving more. Okay.
It could be that that strange result that you had before is because there is some substitution between making an investment versus, you know,
First of all,
whether it was
I have
medical
lots of strange
expenses and
results in this
food.
paper. So by strange result, do you mean the slopes that were confusing?
You know, you had that up and down feature.
Yeah, sure.
So it could be that if you just $1 or $2 above the cutting point, you know, you got this new access to credit, but your credit score isn't very good, so you're pretty limited in terms of investments you can do. So you're using that money to, you know, get another meal or something.
Yeah.
But once, if you are 5 points above the credit score, then you might be able to also get another saving instrument because you also qualify for something else.
Yeah, that's a fair point. I mean, we don't find much on most of these investments, though. That's the other thing. I mean, we're not finding any sort of business activity that arises out of this.
But I think, you know, it would be interesting to look at the elasticity of substitution between how much they spent extra on various.
Yeah, but we don't have that kind of data. That's similar to what Joe was asking me. That would have been that's very fascinating, but we just there's no way we can get access to it. We didn't ask that question. So, yeah.
Prashant, if they're not investing in businesses or not making up new businesses, then how are they paying it off?
Well, these are small loans. They're probably just paying it off when they make some income.
Get the
within
next
the
salary
30
or
days.
something.
Yeah. I remember the average loan size is $5. Average income is about $2 a day. So, you know, it's a short-term loan. They take it out. They pay for some medical expenses or pay for education, and then they're able to pay it off within the month. Yeah. Remember, they're also able to save. So clearly, I mean, it would be really suboptimal for you to be saving and taking out a loan at the same time.
Right.
That wouldn't make any sense because the interest rate is 7.5% per month. Like, why on earth would you do that? If you had the money, you should just pay for it and not take a loan, right? So, yeah.
So since the loans are so short term, you wouldn't even expect to have any impact on their investment or.
I'm with you.
Right.
Yep.
That's.
Yep. I completely agree. We didn't expect to find these effects, and we don't. So, yes.
So in the data, is there any change in levels of loan the further you get from the cutoff? Do they take less?
No, they take. Oh, do they take? Oh, for the entire distribution?
As your credit score gets higher, do they start taking out less money, or is there any just kind of shift in the average loan size depending on credit score?
It's a question that I can answer, but I don't have an answer right now.
Okay.
We have the data to answer that. Yeah. Did you have a theory why that would be interesting?
I just am thinking maybe as you increase your credit score, you get better with spending. You're less likely to have to take these microloans, so you're able to turn.
Oh, I see. You just turn to lower interest rate options or things like that.
Yeah, something like that.
Yeah, absolutely. Okay, so 34% of those eligible take it up. That's a pretty high take-up rate. We don't find that it substitutes for other forms of formal or informal credit. We find some evidence of improved resilience. The education spending result is there, but it's one coefficient out of many, so it is caveated by that. And we pretty much find no effects on assets and employment. We don't find any differential effects by gender. I didn't show you that result, but that is the case. Okay. I'm going to show you something else that we're currently working on, which is the same concept but interacting with the broader sort of banking market. So what we have is an interest rate cap that is imposed in Kenya. This is in the run-up to the election. The president thought it was a great idea to impose interest rate caps to appease people. So this started in September 2016, was announced September 2nd and implemented on September 14th of 2016. This was the limits, 14% per year on loans. Think about that. This is a 7.5% per month interest rate. And the interest rate cap on loans was 14%. And then they also put a savings floor, an interest rate on savings, which is 7%. Okay. M-Shwari monthly interest rate is about 7%, and the annual savings interest rate paid on savings annual is between 2 to 3%, and it's sort of graded. Like there are thresholds. If you save more than 5,000 shillings, you get a higher interest rate, so on and so forth. Okay. So what does this do? Essentially, in the broader market, there are now banks facing. They're going to have to kick out all their crappy borrowers.
So the more people come to this.
Aha! And who? The people low on the credit score are going to show up in M-Shwari. Let's see if that's true. It's exactly right. Okay, and they're also going to save. They're going to stop saving in M-Shwari because they can go save in a different bank. Right? So it alters this distribution. Okay. So this interest rate cap applied to banks. Okay. Don't worry about these non-bank financial institutions. This is where M-Shwari escapes it, because they called it a facilitation fee in their filing documents. So they were exempt from this. This is some kind of scam. But the floor on the deposit did apply to M-Shwari accounts. Okay, so you see this shift. Let's see what we get. First of all, this is just the cutoff from the date. So we have admin data on access to loans. This is literally whether someone is more likely to take out a loan after the interest rate caps come in. The answer is yes. Okay, this is for the entire distribution of credit scores. Okay, which is why you see sample size go up. This is all from the admin data. Okay. Now, the higher your credit score, you should absolutely not be borrowing from M-Shwari because you get a much better interest rate outside. Okay, much lower interest rate outside. It's exactly what we find. Post caps times the score cutoff. Essentially. So this is the interaction between the post date of the implementation of the interest rate cap, and the higher the score, the less likely you are to have a loan with M-Shwari. Okay? And we can do the same for the positive score sample. So we just focus on the positive scores and sort of see what that does, and we find the same results. Okay? What should it do to savings? Okay? So the interest rate caps seem to increase savings. So post-interest rate caps, the fraction of people saving in M-Shwari goes up. The log amount of the savings also seems to go up. Okay. And you can trim this by various amounts, and we get the same result. Okay. So, but this is the result that we are really interested in and sort of exploring more, and also considering ways to think about once this interest rate cap comes in, whether people strategically default. If you're a high credit score guy, you strategically default on your M-Shwari loan and now just go to the next bank and get a much cheaper loan. We're trying to think about ways of sort of assessing these features.
Was it a permanent change that was announced, or a temporary one that's the caps? Does it sunset, or?
No, so no date was announced in terms of when the caps would stop coming into place. Okay. I believe they are no longer in place, so it's now reverted back. But they were, at the time of the announcement, there was no sense of, this is within 45 days before and after. That's the threshold that we use.
But there wasn't an announced time when the...
No,
okay.
no. The government said, this is the cap now, and this is it. Good luck, you know, so. Yeah. Okay. So in the first paper to study the effects of access to digital credit on various outcomes, we find high take-up, and these effects, the effects that we find are in line with loan types. So we find nothing on investments, nothing on sort of productivity, labor supply, things like that. We find effects on sort of household resilience and consumption smoothing to some extent. We don't find substitution from other loan types, so this is truly, we interpret these results as an expansion in access to credit. And I think what's fascinating for us is to think about the interaction of this digital credit market with the broader financial markets and sort of how those things interact, as we learned from the example of interest rate caps, would be good, sort of a great direction for future research in this area. Yeah.
I think one of the things that's most remarkable about this is how savvy those people are.
Yeah.
You know, you would not expect, even though they have quite a lot of education, so surprising to me that the average education level was 10 years of schooling.
10 years of schooling.
Because it takes it takes a certain level of sophistication to respond, so...
No, but that's the thing. So I actually think the reason this product has seen such remarkable success in terms of take-up is because it used the same platform that people had been using forever. So the real question is, how did the spread of M-PESA take off? How did people learn about, so the mobile money, which is the original platform upon which the credit platform is built, right? So the takeoff of M-PESA, I agree with you, is a fairly astounding
No, but also the fact that they responded so clearly to the cap on the interest
Oh, but
rate.
the cap was a huge deal because the government made a big deal of announcing the cap because it was a few weeks before the elections.
Right, but
Yeah.
that they responded
Aha.
so quickly and figured, oh, this is now, I don't have that option. I mean, I'm surprised that
Yeah.
in Kenya with such low incomes that they would be so savvy in terms of responding to price incentives.
To be fair, I can't truly tell you that the response is coming from the low-income types. All I'm showing here is that the response is coming away from potentially high-score people. This is not within the bandwidth of my study, by the way. This is for the entire distribution of credit score. So you're right. I mean, I'm sure there is a level of sophistication that maybe is worth looking into, but I'm not going to draw that conclusion just by looking at this number, because it's possible that the very high credit score guys are the ones who are leaving. And I can't quite show you that with this.
And you can't test whether...
I
you
totally
can't-
can. I totally can.
You can.
Yeah.
Because you could use a method, I forgot what it's called right now, where you're looking at, you distinguish between how the people in the median react and how the people in the lowest
Quantile?
10%. Yeah,
Yeah, absolutely. Yeah.
I would do that.
Oh, that's actually a great idea. We could totally do that. Yeah, right.
But isn't it, so my understanding of this story is that, I'm out and about, I'm trying to get a loan, and the government now imposes this cap. I go to the place that I would have gotten my really high interest rate loan before, and they say, yeah, sorry, but we're not going to lend to you now.
You're not gonna lend.
Too risky. If 14% is the highest
Exactly.
interest rate we can do, sorry. And then I walk away and I say, okay, well, now what do I do?
Yeah.
Okay, now I've got this
Yeah.
thing on my phone. That explains.
This positive coefficient. Shoshana's question was what explains this negative?
Right. And so
Who are
it
these
could be-
sophisticated borrowers who are now saying, oh, I get a better loan there? I mean, when we went mortgage loan shopping, I mean, we met two people and we're like, done, let's just pick one. Let's not look at 18 options, right? So we were very unsophisticated in that.
So another question I have is, how does this tie to the broader policy questions in development economics? Like, how does the World Bank, for example, and we react to this?
Yeah, so
Because there's a whole establishment
Yeah.
that's working with those more traditional institutions.
right. So I think the way this responds to questions that have to do with policy is in a few ways. One is when thinking about financial inclusion, that's a big buzzword for the Gates Foundation, for the World Bank, all these things. Are people now using financial tools
Right.
to potentially improve their lives? If that's the big umbrella question you're asking, we're providing a minuscule answer saying perhaps, because these digital credit loans seem to allow people to overcome some shocks and not forego as many payments. So maybe providing financial inclusion or improving financial inclusion through this technology seems to be somewhat useful. In terms of it speaking to policy responses that have to do with microfinance, I'm going to say we don't have that much to contribute to that space. Because microfinance loans are geared at a much higher level. So a good experiment to do would be to really take this credit score stuff seriously and maybe have digital credit at a much higher level amount. So let's start giving $500
To compare
loans.
the microfinance versus the mobile finance.
Yeah, and a lot of that is going to come down to ease of access of digital versus traditional microfinance, the not requiring group lending in terms of microfinance. So a lot of those questions I think will come down to figuring out how well this credit score system actually works. Yeah. So I think that's sort of the other policy way in which we can think about this. The third way I think is the broader question of the role of private enterprise in developing countries in terms of providing tools that allow for poverty alleviation. So a common response is to think about governments as providing poverty alleviation tools. This is a completely private enterprise that is, putting on my Chicago hat for a second, I can't help but do that from time to time. I mean, this is a great way for the neoclassical Chicago person to say, hey, look, private enterprise can deliver a lot of these benefits. And the government has no incentives. The government actually will be very expensive to do the same thing for the government, right? So private enterprise comes in, can provide $1 loans and make people better off.
I mean, I'll let other people ask.
Yeah.
So to better understand the RD result, would that be helpful if you just run the simple OLS regression, basically outcomes? On the treatment, basically, is going to be whether you get a loan or not, and control for the credit score.
That's essentially what the RD does.
Right.
Yeah.
Have you tried that regression?
But that is what these, all of these estimates. So I'm sorry I didn't show you the exact specification, but all of these control for the running variable in the spline form.
But instead of just using the local, that part of the distribution?
Oh, using the whole distribution?
Right.
Oh, not possible for us because we only surveyed people in the bandwidth. So we didn't survey people outside the bandwidth because that would have been too expensive. Okay. So we went in with thinking about the RD design. We did a power calculation and using optimal bandwidth,
right.
And then we only survey people in the bandwidth. So we have no clue what a person with a credit score of 15.
Okay.
We have no clue about their consumption.
So based on the video clip that you showed to us, do you know, basically you propose a amount of money you want to get loan, you get reject or not?
Yeah.
Right? Did you ask that question?
I know I wanted the data so bad. I wanted to see how people learn about their credit limit and how many times they go, I want 500, I want 499, like what that process is.
Probably can compare people who apply for the same amount.
I know, yeah. You're speaking my mind here, but yes. I wish, but sadly we don't have all the,
right.
Because that's never recorded. What's recorded is what they get.
Right.
So we see the outcome,
Exactly.
but we don't observe what they wanted. Yeah.
Do you observe how the credit score has changed?
Um,
2 years.
No, so the credit score doesn't change for these guys. The limits change for these guys over time. We don't observe their credit score changing within our sample. Yeah.
One of the things that occurs to me is that anthropologist Saul Tax, did you ever hear about him? He was at Chicago in anthropology. He was a good friend.
He was in anthropology.
He was a good friend of T.W. Schultz.
Oh, yes.
And when I was a student there, I was a research assistant for T.W. Schultz. You probably studied with Steve Paul Schultz.
I did study with Paul, yes.
Yeah, he's fun. Now, Saul Tax wrote a book called Penny Capitalism. And basically, you should cite it in your introduction.
Okay.
Because he went and did some field work, I think in Guatemala, if I'm not mistaken. And he showed how people in these villages are really capitalists. And then you can say, well, it's also true in Kenya.
I should definitely take a look at this book. Sounds great.
Right. Thank you.
Thank you so much.